Hello and welcome to the Daily Brief by Zerodha, where we cut through the noise to bring you the most important market moving news. I'm your host Tarun, and in this special episode, we will cover the top 5 topics that we've spoken about in the last 2 weeks. So, let's begin. Let's start with the thematic and sectoral mutual funds. Since mid 2020, we've been in a bull market, which brings all sorts of crazy behavior, both entertaining and depressing. A prime example is the huge inflows into thematic mutual funds and ETFs. These funds focus on specific sectors like defense, healthcare, and auto, and they are very risky. The themes and sectors can shoot up quickly but can also underperform for long periods. For instance, the Nifty Real Estate Index, infrastructure, and commodities have lagged behind the Nifty since 2008. But in a bull market, it's all about no risk, only greed. From January 2022 to June 2024, large cap funds saw inflows of 17,000 crores. Mid cap funds got 55,276 crores. Small cap funds received 74,112 crores, and thematic mutual funds attracted a whopping 1,22,192 crores. It's wild that thematic funds are getting more money than small cap funds, a favorite amongst retail investors. Before COVID, these numbers were much smaller. From January 2022 to June 2024, new thematic schemes grew by almost 50%. The craze for some themes is off the charts. In June 2024, Motilal Oswal Mutual Fund launched a defense index fund, raising 1,676 crores during its new fund offer period, one of the highest ever. So far in 2024 alone, thematic funds have raised 33,670 crores, a level of frenzy we haven't seen since the close-ended fund madness of 2006 and 7. Interestingly, HDFC, which launched its defense fund in 2023, stopped new SIPs due to a massive surge in defense stocks. In the last year, defense stocks have jumped between 100% to 700%. Thematic funds can skyrocket quickly and then do nothing for over a decade. That's like driving by looking in the rearview mirror. For these stocks to justify these prices, they have to deliver ridiculous earnings growth, which seems implausible.
Now moving forward to the next story, let's talk about the unreal growth of the real estate market in India ever since COVID-19. Look, India's real estate market has struggled since 2010. However, since COVID-19, the market in both the commercial real estate and the residential real estate sectors has seen a big boom. Recently, Knight Frank, which is India's leading property consultant, published a report analyzing India's real estate in the first half of the year. This report analyzed the performance of real estate across 8 major markets inclusive of Mumbai, Bangalore, Chennai and Kolkata. There were some really interesting insights about the industry in this report. Let me walk you through it, starting with the residential real estate market. See, ever since COVID, the residential real estate sector has seen a phenomenal recovery. Sales volumes have grown as much as 29% since 2020, and it even hit a 10-year high in 2023. 2024 has also been a great year. The momentum has continued in the first half of the year. Residential real estate has grown 11% year on year and has also touched a 11-year high. The demand is so strong that there is now a very visible premiumization of preferences among Indians who earn very well. Premiumization, by the way, is a trend where people are now looking to elevate their lifestyles. Also, this trend is not only limited to real estate, it is also very easily visible in things like FMCG, clothes, entertainment, electronics, etc. Now to explain this premiumization, let me give you some very interesting numbers. First, houses priced above 1 crore rupees have contributed 41% of total sales in these 8 key markets. Second, sales in the 1 crore plus price segment have grown by a massive 51% year on year. Third, sales in the 50 lakh to 1 crore price range have dropped by 8%, and those in the below 50 lakh category have dropped by 6%. Now why is this happening, you may ask? 2 main factors. First, as we already discussed, the focus and preferences of home buyers have started to shift towards premium houses. Second, the interest rate on home loans have gotten higher. Plus, the lingering effects of the pandemic could be much more in the under 50 lakh customer base. The only negative point that this report highlighted was about unsold inventories. Look, while the overall inventories grew by 3% year on year in the first half of 2024, those in the 1 crore plus category saw a 27% increase. However, the report also mentions that the speed of sales has consistently increased. This means that inventory is not that big a concern at this point. The Knight Frank report also spoke about the commercial real estate market. Let me quickly walk you through what it said in 4 simple points. First, similar to residential real estate, commercial real estate has also hit record highs in 2024. The first half of 2024 saw the highest ever volumes in a half-year period. Second, Indian businesses seem to be flourishing and are increasing their commercial real estate leases. Such transactions have jumped from 35% in the first half of 2023 to 41% in the first half of 2024. Third, foreign companies aren't sitting quietly either. In the first half of 2024, they leased 48% more space than they did in the first half of 2023. Fourth, because of the strong residential market, most developers have focused on that very market and new commercial project completions have gone down. Now, this has led to commercial real estate inventories dropping to single digits in some important markets. The lack of new supply is also forcing rents to go up.
Next up, let's talk about RBI's new guidelines on interest payments and how they'll hurt banks and NBFCs. If you've never taken a loan before, here's how it usually works. First, you apply for a loan. The bank then checks your history and the documents you've submitted. Then it sanctions the loan and gives you the sanction letter with the terms. If you agree, you sign the sanction letter and return it to the bank. You complete more paperwork and sign the actual loan agreement. Finally, the bank disburses the money to you, often a couple of months later, for things like home loans. Now, when should the bank start charging interest? After the disbursement, right? But some lenders were charging interest as soon as the loan was sanctioned, or even earlier, squeezing in that extra interest payment from the borrowers. The RBI found this unfair and in April issued a circular demanding that banks charge interest only after releasing the funds. This is great news for borrowers, but for investors in banks and NBFCs, it's not so great. Expect to see a dip in their June results profitability and net interest margins. Banks are already in a fierce competition for funds, and this will add to their challenges. The RBI's job is to maintain monetary stability, and it's been tough on banks and fintechs recently, cracking down on KYC processes, interest charges, loan disbursements, and fintech partnerships. The RBI has acted against 161 entities this year alone, including banning Kotak Mahindra Bank from adding new customers due to IT issues and nearly killing Paytm Payments Bank. The RBI's goal is to manage new risks without stifling the sector's dynamism. Moving on, let's talk about how UP is making hybrid cars more attractive. In a bold move to go green, the Uttar Pradesh government has announced a groundbreaking policy to waive the road tax on strong hybrid electric vehicles until October 2025. EV penetration in India is barely 5%. For sustainable growth, India has to move away from the internal combustion vehicles that worsen pollution and climate change. The government of India knows this and has introduced lots of subsidies, and now states are also following suit. Normally, UP charges a road tax of 8 to 10% on petrol and diesel cars. Removing this tax could make hybrid cars up to 10% cheaper in UP, saving buyers up to 3.5 lakhs. And I'm sure this makes eco-friendly vehicles much more attractive. Don't you think so? R.C. Bhargava, chairman of Maruti Suzuki, India's largest automaker, said this, and I quote, "It has become quite apparent that achieving zero emissions and reducing dependence on imported oil cannot be achieved only by electric cars, at least not in the foreseeable future. Alternate positive technologies are required." He also mentioned the importance of alternative technologies for reducing oil dependencies, and this is what he said. "Besides CNG and hybrids, we are pushing strongly for biogas and ethanol. These fuels are produced from our own natural resources within India, have no import content, and will greatly impact emissions and the atmosphere." According to a report by Motilal, around 90,000 hybrid vehicles were sold in India in financial year 24, accounting for about 2% of total car sales. Key manufacturers include Maruti, Toyota, and Honda. This tax reduction could boost hybrid car sales further and encourage other states to implement similar policies. Let's now talk about the stupidity that China is up to by banning short selling. Just a few years ago, China seemed to be doing everything right with its economy. Now it's a tricky place to invest in. Here's a quick summary of what's going wrong. First, overinvestment. China invested too much to keep its growth rate high, and it invested even when there was nothing worth investing in. Second, low consumption. The government suppressed wages and didn't spend on social welfare. So, China never became a consumerist economy like the US. Chinese factories rely on foreign markets, which is why China exports so much. Third, heavy real estate focus. A lot of investment went into real estate, including people's savings, and it eventually created a bubble. Now, when this bubble burst, people lost their life savings, and construction companies inevitably fell into heavy debt. This gloom has spread throughout the economy. Chinese companies have seen no earnings growth, and the stock market has underperformed global markets over the last 5 years. China doesn't like its state indexes falling, so it orders state owned companies to buy stocks when the market is down. In just the first quarter of this year, a single state fund supposedly bought $41 billion worth of blue chip stocks. But even that hasn't helped. Last week, the Chinese CSI 300 posted its seventh straight week of decline, wiping out $1 trillion of value. The Hong Kong Stock Exchange has also seen a dramatic fall. China is in a bear market through and through. Investors are now looking at China's third plenum meeting, which starts on Monday, before deciding how to act. The third plenum is a meeting of top Chinese policymakers which is held once every 5 years, where big decisions are made. Meanwhile, the Chinese government is upset with its own stock market and is targeting short sellers. On Wednesday, it reduced the leverage that short sellers could take and prevented the state owned China Securities Finance Corp from lending shares to short sellers. But this is more of a PR stunt. Short sellers make up only 0.05% of the Chinese stock market's value. More importantly, short sellers play a crucial role in the market. They are like the janitors of the market, cleaning up stupidity, greed, and fraud. China isn't the first country to go after short sellers though. Recently, South Korea made short selling punishable by life imprisonment. But research shows that this is dangerous. When there are no short sellers to push the prices down, markets are likely to crash all at once when the public finally hears some bad news. This is especially true in markets where companies tend to hide bad news. Eventually, China will have to address the real problem, which is its terrible economy, rather than trying to make its stocks look good. Hopefully, that process starts next week at the third plenum. Thanks for tuning in, and we'll see you in the next one.